Investing in real estate has been one of the most lucrative and safest investments that someone can get into. However, the barrier to entry is usually much larger because you have to come up with a 20 to 25% down payment on anywhere from $300,000 to up to $1 million. So if you're thinking about investing but you don't want to put out that kind of money, or you don't have that kind of money, I might have a solution for you. Today's guest is Ryan Tanel with Top Producer Capital Investments, and he's going to show you or tell us how he helps investors through syndication buy into smaller and larger apartment complexes to get good returns. But before we do that, be sure and subscribe to us on our YouTube channel. Also, we have all of our podcasts on all of your favorite podcast platforms. Just go into whichever podcast platform you like and type in RealtyHack and subscribe to future episodes. All right, Ryan, I'm here with Ryan Tanel, and we're going to talk about your business and kind of really, you and I met through our mutual friend, Erica Albert, and you gave me a brief glimpse of what you do, and I found it pretty interesting, thought it'd be good for my podcast. You explain it.
Sure. So our company is called Top Producer Investment Capital. It's essentially multifamily syndications. So what we do is we raise money from a number of investors, about $50,000 at a time. I mean, you can put out how much you want in.
Sure.
And we'll pool investors' money to buy bigger apartment complexes. Mm-hmm. We'll still get a mortgage on the apartment complex. So let's say we're buying a $5 million building. That's a 50-unit building. We need $1 million down payment. We'll send out an email blast and say, hey, who wants to put in $100,000 to this deal? You'll be 10%, 5%, whatever percent owner of the deal. And then we operate the deal. We find them. We manage them. We do the renovations. Then we eventually sell it. And the passive investors get cash flow along the way, and then they get profit share of the proceeds when we finally sell it.
Gotcha. So, and what areas do you work in?
We just do it in Texas.
In Texas, yeah.
Yeah, we're typically on the smaller end, between 10 and 100 unit multifamilies. I say smaller end, I mean it's bigger than houses, but usually medium and larger multifamilies can go from 100 to 500 units. So we're on the smaller side of that.
Sure. Okay.
But yeah, just Dallas, Austin, San Antonio, and kind of the smaller cities in between.
And do you work with different like real estate brokers in those areas?
So there are multifamily brokers that will send us deals. Yeah.
Gotcha. Okay. And so, do you happen to know Donnie Giroux in Baton Rouge?
No.
Anyway, he's a good friend of mine, part of my ex-wife's. Let me cut that out real quick, okay? She's not my ex yet. I don't want to do this. So, he's a good family friend of mine, and he does the same thing with commercial. What is it? Strip centers.
Yeah.
And his formula seems a lot like the same, where he looks at like maybe C and D, mm-hmm. and then he'll renovate them. Usually has like almost like the same kind of like if you go down if you're in Louisiana and you see a complex, you'd be like, oh, that's one he did. Mm-hmm. So what is a typical hold time to it?
So there's a couple of philosophies. When we underwrite, we always tell investors to prepare or expect a 5-year hold. Mm-hmm. Usually we can finish all the renovation and constructions in about 2 or 3 years. And then my philosophy in that, if we can make the same amount of money in 2 or 3 years as we would in 5, let's just kind of cut our period short, get the money back to investors and roll it into the next project sooner. The only exceptions would be like right now, if we're in a market where interest rates are really high and it doesn't really make sense to sell, or we have a deal that cash flows really well, but the resale value isn't as high, the cash flow deals will hold for a longer time.
And are you finding right now, because the lending environment is been kind of volatile, that you're seeing better deals?
Yeah, a lot are coming to surface, and I think the difference between residential and commercial is that a lot of commercial mortgages typically have balloon payments after either 5 years is typical. Mm-hmm. A lot of people in the last couple of years did bridge loans where it had an adjustable rate mortgage that had a balloon at 3 years, and then you could extend it for 1 year and then another 1 year if you met certain debt service coverage ratio criteria. And the trouble is, a lot of these people had high aggressive assumptions about how the market would be in the next 1, 2, 3 years.
Yeah.
About how much rent growth they would get, how cheap construction would be to get there.
Yeah.
And so a lot of these people, in my opinion, overpaid for some of these buildings.
Sure.
And maybe thought it was easy, didn't have the operational skills to get it where it needed to be, or even if they operated it correctly, but their interest rate went from 3 to 6, and then their mortgage payment went up quite a bit. Now they don't qualify for that 1-year extension, and they have a balloon payment coming up. They either have to just sell it at whatever price it is, or try to do a refinance. But because these loans are debt service coverage ratio loans, the value of the building's gone down, and the loan amount that they qualify goes down. So they might have to pay $1 million to be able to just refinance these loans.
Yeah. Yeah, and I mean, and some of them, I would imagine, there's probably situations where they're savvy investors, but just wasn't expecting the interest rates. I mean, who was? They get more than double. And then commercial interest rates are much higher, right?
Yeah, they're similar. I would say, today we're here in February. I mean, they're probably about 6.5%, 6 to 7%, kind of depending on what kind of loan you get.
Yeah. Okay, and I guess so when you get a loan on something else, or nowadays, is it similar type 3 to 5 year balloon?
Yeah, that's if you get a hard money, or it's not hard money, bridge money financing. Yeah. There's lots of types. You can go to community banks, like if you would go, we've used like Prosperity Bank or just a couple local ones. They'll give you either 20, 25, or 30-year mortgages, and those don't have balloon payments, or they might have a balloon payment in 10 or 15 years, and everything's negotiable. So
sure.
Typically with residential loans, you get a deal that's 30-year fix, or maybe adjustable if you want that. But in commercial, you can really negotiate any terms you want. Every bank has a different opinion, and there is still the big lenders like Fannie Mae and Freddie Mac do commercial mortgages, and those are still 30-year fixed. Without a balloon payment, they might have an adjustable rate after the 5 years or something. So there's lots of options.
Yeah. We own 6 duplexes, and we had residential loans. I think we had 3 to 5 years, okay, arms on them, and it made me nervous. And so when residential rates were like at, around 3.5 to 4, we got a commercial loan on them, and it was like, I think it was 5.5 at the time. I was like 5.5, but it was a 30-year loan, amortized like that. And so, especially after what's happened, I'm thinking, wow, that's in hindsight, that was a pretty good move.
Yeah.
So tell me, back up a little bit and tell me what is your history? How'd you get started in this?
Yeah. So I've been in real estate in general for about 10 years now. I started reading Rich Dad Poor Dad, and then every other real estate book, and talking to people who made money owning property or flipping property, and I just knew that eventually I wanted to get to the point where I could own a lot of property. And it just made sense that real estate was a vehicle that had a proven method that if you build it once, work really hard, and then you end up owning something, you can step away and have passive income and retire, or have the freedom to do whatever other business you want. So that was really attractive for me. One of the things they say in Rich Dad is, hey, you should work in the industry that you want to build a business in so you can learn it from the ground up. And so I got a job doing mortgage lending, doing residential loans. I worked on my own I worked as an assistant for the first 4 years, and then the next 3 on my own.
Where was that at?
I was at CMG Mortgage for 7 years.
Okay, yeah.
Yeah, and they do conventional,
FHA,
all the normal kind of loans. Yeah.
So was that here in Austin?
Mm-hmm. Yeah, it was in Austin. Yeah, they've got a couple of branches in Austin, and I was at Lakeline they've got like in the Chase Bank building up there.
Yeah, so you probably know a lot of the local realtors, huh?
Yeah. Oh, yeah. We had to know. I mean, I had a database with probably 300 or so realtors that we would send out marketing or get referrals from. Yeah.
Okay. And so when you wanted to start this company, how'd that go?
Yeah. So I had bought my own duplex as a house hack, and then single family, and then I'd done a couple of flips for houses, and I joined multifamily mentoring groups, Jake and Gino and Real Estate Lab, and just did a lot of research on my own for about a year while I was doing mortgage and studying all of this. And then I saw how profitable it would be, and I saw how multifamily apartment complexes are a little not easier, but financially they make more sense because there's only there's a lot of units that are getting cash flow. If 1 or 2 go vacant, you still have the rest that you're relying on. You can have the marketing and efforts you're doing on 20 or 50 units and be just as much effort as it is to get a single house.
Yeah.
So it just made sense that it was, bigger and scalable. And then when you combine that with syndication and raising capital from investors, how people who have a lot of money and skill but don't want to do real estate, or they just don't have the time to do it, or maybe they've had a bad experience giving money or to buy a property and then have a property manager run it to the ground and they don't know how to fix
Sure.
it. So it made sense to kind of combine those where you put the effort from the operator with the capital from someone passive. So yeah, my journey in that was that, I basically saw that it was a good plan, and I quit my job being a loan officer before I owned any multifamily. I still had my single families, but I was selling them off as needed.
Yeah.
And then I spent a year underwriting deals, touring properties, making offers, and this was in 2021. And so the market was really hot right then, and people were overpaying for stuff, and I didn't want to overpay for anything. And I think I had to underwrite 180 deals before we got the first one under contract.
Wow.
And I mean, out of those, I'd probably toured, I'd say 50 or 60 of them in person on site, making relationships with brokers.
Yeah.
So the first one we got under contract was a 32 unit in Gonzales. We bought it for 1.7 million. We got it from a wholesaler, actually. It wasn't like a full broker. So we assumed the contract from them, or they assigned it to us rather. And then, we had a $400,000 renovation budget. So we did all of that. I think at the time we bought it, the rent for the whole property was $16,000. And after our renovations right now, we got the rents up to about $29,000 on average per month. So it's just a huge increase.
Yeah.
And the expenses are pretty steady, you've got your management, you've got average repair and maintenance and utilities. But, I'd say we probably spend, with expenses and mortgage payments, 16 grand. So we're probably taking home 12 to 13,000 a month.
Wow.
on that property as a whole. And that was just the first one that we did. So that was the first one. That was in April of 2022. And then shortly after that, we got 4 more under contract and closed that year.
Wow.
As a general partner. So we did a 14 unit in Canyon Lake. We did a 40 unit here in Austin. We did a 75 unit in San Antonio, and then we did a 12 unit in Dallas.
Okay, so when you're doing this, so you have to. I'm just trying to wrap my head around this. It's basically you're doing a general partner LLC, and then you're the managing partner, right? And I have a little bit of experience with this, not much, and then the people that are in the fund join another LLC. Is that right?
So this is there's like a fund model that you can do, but we just do direct syndications. So what I'll do is I'll get a property, I'll get it under contract, and then I'll say who wants to be a part of this.
Yeah.
And so we make a brand new LLC, like 123 Main Street LLC.
Yeah.
And then the general partnership is a part owner of that, and then the limited partnership is also a partner on that. The general partners have all the voting rights to do whatever they want with the property.
Yeah.
And the limited partners are just passive. They're just along for the ride, but they still own the property just as much, and they still get the rights to the profit share. And if the general partners are committing fraud or negligence or something bad, the limited partners can kick them out or take over or whatever.
Yeah. Right. Okay. And so did you have to get any certain types of license for this, or?
No, yeah, you don't need. I used to have my mortgage license, but you don't need that. You don't need a realtor's license. You're just buying it as an investor, just like anyone else. There are financial security analysts that, if you're raising capital and you have a license, there's more disclosures that you need. But back in, I want to say at 2011 or 12, they allowed these syndications to be done without having a financial analyst license, like a Series 7 or 63.
Yeah.
As long as you do these securities exemptions when you do the syndications.
Got you. And is there a limited amount of investors you can put at each deal?
So there's a couple types of raises that you could do. The most common is called a 506C. You can have any number of accredited investors come into your deal. And accredited basically means you either have a net worth of $1 million or more, or you've made at least $200,000 a year in income for the last 2 years, and you're likely to continue that.
Okay.
So if you're using accredited investors, you can have any number of them, and you can even publicly advertise that. There's one called a 506B, which means it also allows people that are not accredited, but only up to 35 of those people can come in, and you cannot publicly advertise. You have to know all of those people ahead of time. Got you.
Okay, that's really interesting. Okay, and then when you, let's say a place in Austin, you have do you have crews that do the renovations for you?
Yeah, so usually we have a few general partners. My specialty is on the operations and finance and legal team. Usually one of the partners is on the more of the construction management side.
Yeah.
So we'll still hire a general contractor to come in and do all that, but we set the budget, and we've done this quite a bit. We get discounts on materials, we get discounts on lots of things because we're ordering in bulk, and then we'll have 3 or 4 different general contractors come in and bid it, and then we'll put all their bids together and say, hey, can you guys come down here? Can you guys come down here? And but then they're the ones running it. So however often we're going out there, it's every day at first, but then it goes to every week, and once a month we're just making sure that they're hitting all the check marks on the renovations.
So when you're looking at a property, let's say like the 35 unit, right? Are you basically stopping or letting them know that their lease is not going to extend, so that when they
Yeah, we honor everyone's lease.
Sure, of course, you have to.
So if somebody, let's say we bought the property right now in February, and somebody had a lease that expires in June. What we'll do is we'll come in, and right now, let's say they're paying $1,000 a month, and we want to renovate it and make it $1,300 a month.
Yeah.
So we won't kick them out. We won't even tell them that we're not going to renew them. We're going to say your new lease is $1,300 a month.
Yeah.
It's going up quite a bit. So you
Yeah.
can stay and pay the $1,300, and that's great for us because then we don't have to renovate your unit. But we'll also say, hey, here's this other unit that we renovated. It's ready to go. You can move into a renovated unit, pay the same $1,300,
Yeah.
and then you don't have to move, and you get a brand new unit.
Oh, that's really smart.
And
Okay.
then, that allows us to, when they move out, then we go and renovate whenever they leave.
Yeah.
So,
So yeah, the some of the almost all the properties I bought have been like kind of like duplexes, and I mean, a lot of those places were in rough shape and had bad tenants in it. And when I say bad tenants that just didn't take care of the place.
Yeah.
And we would do something similar, but we wouldn't offer them a new place. We're like, all right, you're out.
Yeah.
We're not going to renew it. And then we've always put good good renovations, good style choices, and raise the rents considerably. Okay, and then what about management? Do you have management crews, or do you just hire management?
So we've done both. There are third-party management companies that we can hire, and they'll come in and they'll run everything for us. They'll do all the leasing, they'll do all the maintenance requests, they'll do payroll and crews, advertising, marketing. They'll do everything for us, and then we just have weekly calls with them to say, hey, here are our objectives as the ownership team. Let's make sure our objectives are aligned on what we're focusing on. So we've done that. We've also done direct management, where I have, like one of our properties, I've hired a 1099 leasing agent and a 1099 maintenance person. It's a husband and wife team. So I got on a call. At first, it was like, every couple of days, I was either in person or on a call with them, training them, teaching them all the property management stuff, how to evaluate a tenant screening, how to properly market, how to do everything you would do with management.
Yeah.
And then they just report directly to me. And that's a nice option because you have more control as the owner. You can go in and change things really quickly.
Yeah.
Make big adjustments. For instance, if you get 4 people moving out in the same month plus 1 or 2 evictions, that's a lot of vacancy. You have the power to just drop the rent right away. You have the power to do whatever specials you want. Whereas with a management company, they will handle a lot of that, but it's not direct. So they still have to have whatever they're doing with your property work in their whole system. So you're a little restricted on what you can do, but it's pretty hands off. Like if you have a good management company and they're doing a good job, you don't have to touch it. Whereas if you're direct, even though you have more control, you're in the weeds, and any problem you have to go tackle.
Well, I would imagine that you're doing it direct. You're doing a smaller units, right?
It's about the same either way.
Yeah.
I mean, we have the 32 units, one we do directly, but it would be just as easy to do 100 units. You just need maybe 1 or 2 more people on site.
Yeah. I mean, I used to own a property management company. It
Yeah.
was the worst job in the world.
Yeah.
And having worked with investors and invested property my entire life, or to my entire career, it's a hard job.
Yeah.
And it's not a one where you have a whole lot of players that are really, really good.
Yeah.
And it's a thankless job.
Yeah.
Yeah,
if you're a management company, you get paid by having a ton of clients that are owners, pay you, your 4% or 6% management fee monthly.
Yeah.
And not necessarily maximizing the rent on every deal or maximizing the value of the properties, just on getting a whole ton of properties under management and then kind of doing whatever you need to keep them mostly occupied.
Right.
But on the ownership side, you're really incentivized to maximize one deal and one rent as high as you can.
Yeah.
So it's a little different on the incentives there.
Okay. And do you have like a set kind of like formula of how, what you're going to do to each apartment.
Yeah. So when we take over, the first like 2 or 3 months, obviously anybody that's living there knows new management's coming in. This is a little scary. Nobody likes landlords in general. So they say, okay, well, is this going to be a good experience, a bad experience? So we want to say, like, hey, we're the good guys. We're here to improve the property. Before we even raise any rents, the first 3 months, we're saying what outstanding work orders never got done.
Yeah.
Let's go fix all of that.
Yeah.
What's around the property? If it looks trashy, if it looks like the lawn's not been kept up, anything that we can do just to make the property better the first 3 months, that's all we're doing. We're not even raising the rents. We want to show them, hey, we're the good guys, and here's what's coming. And then
You're doing the exterior first.
All the exterior, because everybody can see the exterior.
Yeah.
Can see the interior.
Right.
But then we will get, after about 3 months, we'll say, hey, here's your new rents, and here's what a turned unit is going to look like. Now, we've done a bunch of these. I mean, it kind of depends on the square footage, but probably a 1-bedroom, 700 square foot. We're doing pretty durable materials that are pretty cheap. So I'd say probably $8,000 with labor and materials to turn a 700 square foot 1-bedroom apartment. Yeah. And with that, you'll get like luxury vinyl plank floors. We're just going to resurface the counters. We're not putting granite in there. These are, C-class tenants most of the time.
Sure.
They're not expecting anything great. And even if you put all that great stuff in there, they're not going to pay more for it or appreciate it.
Yeah.
We'll probably either paint the cabinets or we might put some new ones in there, but usually just paint. We'll put like a new vanity in the bath. We'll resurface the tub. We'll do new fixtures, so like new ceiling fans, new 2-inch forward blinds.
Yeah.
Either black or chrome handles on the faucets or the shower heads. We'll do a backsplash in the kitchen. That's like $500. That makes a difference.
Yeah.
And then we'll pay professional photographers to come through and do the 360 Matterport, good photos, put it up on Zillow and apartments.com and wherever else we can.
Yeah. What's funny is we had pretty much the same formula, except we would put quartz in it because a duplex can command a little bit more rent with that,
And the value of the property on a duplex, like the quartz countertops, goes directly to the value, whereas in commercial, the materials don't matter. They're just going to look at what's your income, and that's the value of the property.
Yeah. Okay. Let's see. What else was I going to ask you? So, do you have like a similar investor pool?
Yeah, so we have a database. We have about 1,100 investors in there right now.
Yeah.
We're always looking for more because, we come across deals quite often. And, I don't want to do every deal. I want to wait for the 2 or 3 good deals a year that are like the best deals that we're going to find.
Right.
And then we say, we'll pull the trigger. And then we email the database out and we say, hey, here's the next opportunity. So, if people are curious, they can go. Our website's topproducerinvestmentcapital.com.
I was about to ask.
Go
so
for it. They can see the deals we've previously done, and they can request.
Wait. Give me the whole website again. Sorry.
Yeah, topproducerinvestmentcapital.com.
Yeah.
And so they can request an invitation and book a call with me or someone on the team.
Yeah.
And we'll basically ask them, hey, what's your investing credibility? What have you done in the past? Are you accredited or not? And then, what's your comfort level and what questions do you have? Because even if people have owned real estate as houses, it's a different animal understanding how that translates to 50 units at a time and then the metrics to say if it's a good deal or a bad deal. And so usually it takes a couple of times of reviewing deals to get familiar with what apartment complex deals look like compared to houses.
Gotcha. Well, Ryan and I are going to be in pretty close contact here. So if you have any questions, put them in the comment section. Check out the video that we're going to have up here. It's very related. Ryan, thanks so much for your time today.
Yeah, I
it's
appreciate
really
it.
Interesting stuff.
Absolutely. Thanks. Thank you.
Thanks.